How's it going, everybody? Just another day in the stock market, and the time has finally come to sit down and have a serious discussion about what the market is trying to do, what the market will do on the short term, as well as what the market will do in the long term. The long term being going into the first few months of 2023, and the short term being the week of October 24th, going into the first 1 or 2 weeks of November. All right. So, for those who follow the Trading Wing Market Outlook, I posted this article about an hour ago titled The Unavoidable Recession. And as the title states, I believe that a recession is unavoidable. In fact, I think the Federal Reserve is purposely trying to induce a recession on their end. Whether they say it or not, based on their actions alone, it seems to me that they're trying to force a recession. And I'll explain why later on in the video. I just want to start by focusing on the short term because we're looking at now, right? We are in the now, we are in the present. And I don't think that this recession is anywhere within the next few weeks. I think it's in the coming months, but I'll explain that again in a few moments. But let's look at the short term and kind of break down what we're seeing here, or what I'm seeing here. All right. So I'm not really looking at fundamentals when it comes to short term, and let me explain why. Okay. The reason is the Fed talk previously, in which we saw another 0.75 basis points or 75 basis point hike. Jerome Powell made it pretty clear. He indirectly kind of made it clear to everybody what the next few interest hikes will be going into the end of 2022. So some may argue that that's already priced in to the movement that we saw, and those price or interest hikes are not really going to affect what the market does on the short term. Okay, so let me look at the technicals and kind of break it down for you. Okay, so I think the most important thing here is the EMA 50. If we look at the daily chart on SPY, the S&P 500 ETF, we can see that the EMA 50, or this blue line, seems to be quite a strong support or resistance, right? When we're over it, we seem to bounce off quite a bit, and when we're under it, we seem to reject it quite a bit, right? We see quite some strong rejections. Now, mind you, there's some consolidation around the EMA 50 before we see a rejection, or consolidation before we see a pull, right? But in either case, that EMA 50 seems to be quite a strong support/resistance region. Now, as I mentioned in the last market outlook, we had an area of high confluence sitting between October 20th and 21st, and we just so happened to have an area of high confluence hit on the 21st, and on Friday, we saw a disgusting move up going from the 362s all the way into the mid 370s, and I mentioned that to the Discord as well, that we were going to make a disgusting bounce upwards, and we did. Now, full disclosure, I lost quite a bit of money on this day simply because it bounced way earlier than I thought, and I took a major L on some put options. So there's that. That's just a full disclosure there. All right. But let me explain why that EMA 50 again is important. All right. If we break that EMA 50 being the strong support or resistance, I can see us moving into the this green region here, being between 382.10 and 388.75, and I think we're going to start trading in this range for a bit before we decide if we're going to pull down again or run up a little bit more. I don't think we're going past that 388.75 region anytime soon. All right, and it's quite important to note down that we could easily reject this EMA 50, right? If we push up hard enough, we could price action back down. And now looking at the trend line here, as well as the horizontal support/resistance, we can see another area of high confluence on Tuesday, I would say between Tuesday the 25th and Wednesday the 26th. And I think on these 2 days, one of these 2 days, we're either going to break above that EMA 50 and continue to run up, or hit that PA, and that could be the volatility we need to pull it right back down. Right now, if we do price action or reject this EMA 50, we're likely going to come back into the mid 360s to high 350s. I don't think we're going to start to hover in this upper region. I think we're going to pull quite significantly, right? So either we're going up significantly or down significantly in the short term. Now, what's interesting to note down as well is there is another area of high confluence sitting on Friday, November 4th. Another important date that I mentioned in my previous market outlook. So this just so happens to appear here. It's really cool to see. So I think another day to focus on is the November 4th on the short term. All right. Now let's look at why I think the recession is unavoidable. And let me break it down for you. Okay. So, as I mentioned, I think the Fed is inducing a recession. I think they're purposely doing what they're doing to cause a recession. And I'll explain why. All right. So, there's a concept called deleveraging, it's the opposite of leveraging, right? So, the Fed's goal really here is increase interest rates to a point where it causes companies to not really sufficiently be able to pay off their debt in a way that they normally would. Okay, so their goal really here is to reduce asset prices in order to make both companies and people feel poorer, or I guess poor in general, right? But if we keep it real, I mean, this will primarily affect the people over the companies, but let me break down more so what I mean. Okay, so this deleveraging essentially will cause or will have companies pay off any and all existing debt on their balance sheets, right? As much as they can, they're going to get that debt paid off while at the same time avoiding to incur more debt. Now, why is that a bad thing if they're paying off their debt? Well, again, with the Fed increasing the interest rates, if companies take on too much debt, the interest payments basically become impossible to pay off, right? They'll do financial harm to the company. And then as a result, the companies are going to either one, be forced to deleverage, right, and pay down debt by liquidating their assets, causing the price of the assets to drop, or they could potentially not be able to do that and pay off their debt or deleverage and cause a company to fail. So it's really forcing the company's hand to do exactly what they should be doing, which is deleveraging, right? And then reducing the price of the assets. Now that will cause everything to plummet and thereby cause the value of almost everything to pull down, right? Now there's an issue on both ends here, right? Because if there's too much deleveraging, this can lead to a financial recession. And then if there's no deleveraging, well, then companies are going to fail. And again, that'll lead to a recession, right? So either way, they're going to have to deleverage, but do it in a way that makes sense. The only issue is to expect every company and almost all companies to properly deleverage and liquidate their assets the proper way is near impossible, right? It's not really likely to happen. So that's one issue why I think the Fed is purposely causing this recession, right? They're incurring this recession really indirectly or directly. They're doing it. Okay. And then on top of that, I think this is the most important one. So I had a look at the 10-year minus 3-month bond spread, and it's inverted for the first time this year. Okay. What exactly does that mean? Well, let me break down, first of all, what a bond is or what buying a bond does. Think of buying a bond as buying existing U.S. debt, right? When you do that, you're guaranteed to receive a certain amount of interest following the maturity date, right? This is known as yield. That interest is known as yield, right? So that maturity date could range anywhere from 3 months to 5 years to 10 years to 30 years. Really, there's a bunch of maturity dates, right? And in a healthy and strong market, the yield curve moves up, right? The greater the maturity date, the more you make, which makes sense. The greater the maturity date, the more you make because there's a greater risk involved. The longer you hold, the more you're going to make. That's pretty standard. So that's in a healthy market. Now, when we're looking at the 10-year minus 3-month curve, we actually start to see it invert. And a couple of days ago, it inverted, which means that if we have a shorter maturity date, we make more money than if we had a longer maturity date. So why would I put my money in the market or buy bonds that I have to sit there and wait on for 20 years to make less than I would if I just bought for 3 months, right? So that's already an issue. That's a call for concern. And then when we look at it historically, this is where the key problem is. Whenever there was inversions of the yield curve, a few months later, there was a recession, right? So the yield curve inversions have preceded recessions by a couple of months, be it 5 months to 12 months. Really, it varies, but it's been anywhere between 5 months to a year and a half, really. But it's always predicted a recession. A couple of times it's failed to, but in most cases it's done so successfully, right? And in most cases, the frame of reference that's used is the 10-year to 2-year spread, not the 10-year minus 3 month. But the 10-year to 2-year spread has already inverted. And then just recently, the 10-year minus 3 month inverted. So what exactly is that telling us? Well, that's a major call for concern. And that's why I think that in the first few months of 2023, I would say in the first 5 or so months, we're going to see a recession. Okay? We may not see it now. We may not see it next week. I don't think we are, right? I mean, that would be strange, but I think we will see one nonetheless. I don't think the Fed is trying to stop a recession. I think they're purposely inducing one. They're causing one, right? And I don't know if they know it, if they're indirectly doing it or whatever it is, or accidentally doing it, but they're doing it, all right? So those are my thoughts. Hopefully you guys stay till the end of the video. If you guys enjoyed it, be sure to hit the thumbs up and subscribe, and I'm out of here.